The purpose of this video is to recap some of the things that we've seen in this class throughout the semester. And the way I'm going to go about this is looking at some of the videos that I posted and just trying to connect the main themes within those discussions. So at the beginning, our discussion was based on the idea that in managerial accounting settings we define costs in many different ways, and some of these definitions may overlap, some of them may not. So one of the themes, or one of the items that I mentioned was, if we are talking about $500 worth of costs, we can split those $500 of costs into whether it is related to production or non-production related. Another way we could split it up is whether those costs are variable or fixed. And we have seen throughout the semester that this theme of variable and fixed is very practical for many reasons. And as I progress on this video, you'll see. But do keep in mind that if we do one classification here as production versus non-production. Some of these product costs could be variable and some of them could be fixed, and the same thing goes for non-production costs. This could be your selling, general, and administrative expenses. So that's what I mean by there's some overlaps. But for different types of analyses, we want to look at costs either as product, non-product, variable, or fixed, or as in the case here, expired versus unexpired. In other words, is it an asset in our books, or is it an expense at that point? So it's either, a lot of times you have assets that have future value, and the moment they cease to have future value, we would just expense them and call them unexpired. I'm sorry, I think I said that backwards. So the expired ones would be the ones that are expensed away, and then the unexpired are the assets. My apologies. But the idea is the same. So we could also look at the factors of production within product related, and we talked about direct materials and direct labor, and initially we didn't talk much about this, but these costs, the direct materials and the direct labor, they're easy to track. And one of the toughest things in terms of costing, the idea of putting a cost to either a product or a service that we provide, is figuring out how to attach the other costs that are not direct materials and direct labor, call those the manufacturing overhead, to the product or service itself. And if you were thinking ahead here, you're thinking we used cost drivers and we used different application methods to be able to do that. Okay, so let's look at where we went from there. So from the first section, we went on to look at how we can use statistical methods to break apart what is variable and what is fixed. So one of the methods we used was linear regression, and the idea here is for us to plot real data. Okay, allow real data to guide our model. And in this case, if you see this particular model, this line that the model predicts is the best fitting gives us an idea of what fixed costs are. So wherever this intersects from 0 to that point where the intersection is on the y-axis, that is our fixed cost. And then the slope, rise over run, is our variable cost per unit. So we first discuss how important it is to break apart these costs, but then sometimes there's relationships that we really cannot see clearly, and the method here, the methodology of using linear regression, is one that allows us to break that apart. So for example, in the results here, this is saying that the intercept is 34.9. In other words, the intercept right here is our fixed cost, and then the variable X is 1.54 or 1.55 per unit. For every unit that is increased, we get $1.55 more. So just an easy way for us to come up with the breakdown between variable and fixed costs. Further in the discussion of defining costs, we, for example, here, this was a clear visual representation of what a linear model is. It has a clear intercept right here, and then it rises after that. But sometimes you get relationships that are not as friendly, let's call them. And if you do, you could still use the methods of linear regression to come up with the model. So when we have something like this, where it just, a straight line would not be the best fitting thing, because of the fact that the errors between the predicted line, which is what I'm drawing here, and then the actual results would be increasing in the middle area here. So what we do in those circumstances is, if you look at the scatter plot, you can maybe come up with different graphs. You can make a break right here and say, come up with a linear model of the data from here all the way to here, and maybe see that this is somewhat fixed costs, if that's the case, or it could be decreasing or increasing. It doesn't matter. Whatever the shape is here that fits a linear line, you can come up with a model, and then you would just basically use that model within that range that is viable. And then anywhere where there's a different behavior, like you see this right here, then we come up with a different model from this point on until this point on. So just because we're using linear regression, it doesn't mean that if the data doesn't fit this nice pattern, then we cannot use it. No, that's not the case. We can. We just have to get creative in terms of coming up with models. This would require at least 2 models right here. From there, we went into cost, volume, profit analysis, or break-even analysis is part of that. And we discussed some of these graphs now that we've noted the importance of defining variable versus fixed costs. We came up with these graphs, and I know this is a very busy graph, but assume that this is dollar amount on the y-axis and then activity here on the x-axis. So this line right here, the bottom line, is the one that depicts total profit. So wherever it meets at 0 on the x-axis, that's where we have our break-even point. And then there's all these other lines here that depict total variable cost rising, total fixed cost flat, and then we have total revenue rising, and hopefully total revenue is higher than total cost. So this is your total cost right here, and that occurs at the break-even point. So these 2 dots are aligned not by coincidence, but because of the fact that whatever this value is on the solid blue total cost line becomes less or the same at this point, and becomes less after that. And total revenue is higher, so that's where your profit is. Okay, so technically the difference between these 2 lines should be the amount difference here too. I mean, this is not drawn to scale, so that's why it doesn't look the same, but that's how it is. So what we use these graphs is to visualize how it is that we can be profitable in a company. And one of the most useful tools for that is the break-even analysis. And you can do the algebra here, but basically the formula comes out to be that you can compute how many units you need to sell to break even by simply taking the total fixed costs and dividing that by your contribution margin per unit. So by definition, the contribution margin is the revenue minus the variable costs. So again, here's where the distinction between variable and fixed costs becomes real important and useful for us. And once we can determine break-even point, we can do a lot of what-if analysis. So the cost, volume, profit analysis relates to break-even analysis and many other aspects as well. Besides just the break-even point, which is this yellow formula here, we also saw how we can modify this formula to include a desired profit. And if you wanted to include a profit before tax, because in this formula, when we put the desired profit, we're probably assuming after tax. So if you wanted to go before tax, you just have to modify the formula a little bit based on this algebra. We also looked at having a mixture of products. And if you have a mixture of products, then what you need to come up with is a weighted average contribution margin. So in the same way that we came up with a contribution margin here for one product, we can come up with a contribution margin per product, and then on top of that, based on the percentage of market share or some other weighting factor. But at the end, you have the same formula: total fixed costs divided by contribution margin, but this is a weighted average contribution margin. So we modify a simple formula in several different ways to be able to analyze different aspects. From here, now that we have clearly defined or clearly understood what the importance of variable cost and fixed costs, then we can start looking at how a company, whether it's a manufacturer of a product or a service provider, tracks these costs. So you first buy your materials, you store it as an asset, as raw materials, and then as you start using it, you put it into the work in process inventory. So both of these accounts are assets, inventory accounts, but this one's indicating that it is being processed at this moment. To that, you have to include labor as well and apply overhead. So this was the key here. This is where we came up with those cost drivers and eventually came up with a final product cost. So once the product was done, then it went over to finished goods, and assuming this is one product, it was later sold, and it went to cost of goods sold. So all of these accounts, raw materials, work in process, finished goods, those are all asset inventory accounts. It's when you sell it that we recognize the revenue, and then we recognize the expense for the cost of goods sold. So the other important theme that I want to leave with here is when we apply overhead, when we estimate this part of the product cost, okay, as we produce or as we provide a service, this is the one that's a little tricky. This is the one where we have to be real careful, because a wrong approach in applying overhead can lead us to believe that we're profitable when in fact we may not be, or vice versa. So I provided you guys with an example where we produced two different types of chairs. Here's a fancy chair, here's a rustic chair, and one of the ways that we initially split those overhead costs was by simply dividing by the total number of units and saying each chair gets $2 of overhead. And even though this is oversimplified, the point is still an important one. So, oops, sorry, just begun by. So my apologies there. So the idea was we can't do that, because if you think about it, if this is the fancy chair, maybe that one consumes more overhead. So it would be unfair to allocate an equal amount to the rustic and fancy. So the use of a cost driver, in this case direct labor hours, allows us to make that distinction. So let me forward this a little bit here. So if we use the cost driver direct labor hours and we come up with the number of hours, then we have a method of estimating how overhead is consumed on an unequal basis. Okay, if we only make it if we only use units to to divide the divide the total overhead, then we might be doing ourselves a disfavor. Okay, we might be allocating too little overhead to the fancy one and too much to the rustic one. So a method that can capture how overhead is consumed is ideal, and that's the whole idea of the cost driver, using a cost driver. And if you have to try to figure out what's a good cost driver, some of the methodologies that we used right here like linear regression, could be used for you to find out what is a good cost driver. So keep that in mind. But in general, companies will have, somebody that's been in business for a while will have an idea as to what cost driver is best to use for that purpose. And here, when we use direct labor hours, we end up giving $3 of overhead to the fancy chair and $1 to the rustic chair. And this provides us with better cost information. So keep in mind that we do these things. We use a cost driver and a predetermined overhead rate to be able to compute a better amount for overhead, manufacturing overhead. Because at the end of the day, direct materials and direct labor, those are easy. Okay, we have information on that. We have direct information on that. But it's the overhead amount that we don't. Okay, then we transitioned into something else. Then we looked at absorption costing versus variable costing. So everything we've done so far assumes absorption costing. So when we were doing these, when we were doing the explanation on the flow of costs, direct materials, direct labor, and all of overhead, that's absorption costing. But we talked about how the gap accepted method can have some distortions when we do what-if analysis internally. So for these scenarios, when we're trying to estimate different levels of production, different levels of sales, where we're altering some of the inputs in our what-if analysis, it is best to use variable costing. And under variable costing, you only include variable costs of production in separate from the fixed costs. In other words, we separate all variable costs from fixed costs. And what in any amount related to production that is fixed, we simply expense every period. And that's important because under absorption costing, the gap preferred method, any scenario in which you make more than you sell is one in which you have fixed costs being kept as an asset as opposed to being expense. So not that this is wrong, it's just this is some of the distortions that you can be created with absorption costing. So to avoid those distortions, we just simply use variable costing for internal purposes, so that every time we change production levels or estimate different levels of production, we do not get a distortion in profitability from the fixed overhead costs. Then we moved into activity-based costing. And in activity-based costing, what we were aiming at is that our goal was to see if there was a better approach than just having one predetermined overhead rate. So if we accept the fact that using a predetermined overhead rate helps us to better allocate costs, like in the fancy chair and the rustic chair, if we can accept that, then under activity-based costing, we're making a more deliberate effort to try to get an even better overhead estimation. It's not just accepting the fact that cost drivers are useful, it's now also thinking about the activities of production. And what we end up happening is that for different areas of production or different services that we provide, or different areas in the service that we provide, there may be a better cost driver to address how overhead is consumed. So, in other words, one cost driver may not be the best thing throughout the production process. And part of the illustration was that if you use these additional, if you break down the production process into activities, and each activity with its own cost driver, we ultimately might be able to get better cost data. And better cost data is power to you in terms of determining whether you can be profitable or not in that industry. So it all just helps us to get a better idea of what it is, what the cost is of what we're providing. And then having looked at costing overall. Our next topic was about capital budgeting, and in this sense, we're looking at net profit, net present value analysis. We're looking at whether investments over the long haul are profitable to us or not. And for these types of long-term analyses, one of the main things we talked about was that cash flow is really important instead of the accounting numbers that we use for the income statement, which are based on accrual accounting. So it's not that the accounting numbers are not useful, because they're very useful. They have they have predictive power in terms of estimating future cash flows, and this has been shown by research. But when it comes for our own analyses of whether something is a good investment or not, we definitely rely more on cash flows than accounting income. And one of the methods was the net present value method. We also used payback method and the accounting rate of return as well. And then finally, we discussed budgeting, and budgeting with respect to all the items that we talked about, so including the production budget for direct materials, direct labor, overhead, sales and administrative expenses. But the key for you to remember is that all these budgets are dependent on our sales estimate. So whatever we think we will be able to generate in terms of sales, that's going to guide what we need in terms of production and what we need in terms of administrative personnel, etc. And these we refer to as the operating budgets. And once we have these operating budgets, then we can come up with the financial budgets. And one of the main things that I wanted to leave you all with is, it's okay, obviously, to come up with all these expectations of sales and cost, etc. But we need to make sure we have a nice understanding in terms of what that results in terms of cash flows, because it doesn't serve us well if we have all these expectations of sales for the next year and then we're going to run out of cash in the third month. So these operating budgets have to tie in very closely with the financial budgets. And the last case that we did, the hope was to get you to see that connection very clearly. And this wraps up my summary of all the areas that we've addressed. I hope you can find the time to put these different concepts together and try to think about how they relate. And hopefully this will be useful in your career.